Hello, I'm Greg Bonnell, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to boost your trading potential. Coming up, NVIDIA earnings are out. It is a beat on the Q4 expectations, better than expected guidance. Now the question is what it means for AI leadership, tech exposure, and broader market risk. B. Riley Wealth's Chief Market Strategist Art Hogan joins us in just a few minutes to unpack it all. Plus, NVIDIA may set the tone for AI, but Marvell is another key player in the data center build-out. We're going to break down the technical setup, key levels, momentum, and what the charts are signaling ahead of its earnings. And then we'll walk through some option strategies for both the bull and bear cases. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour to the trading day. Let's check on the S&P 500. We got some decent green on the screen, but it is not a tech-driven trade right now for the broader market. We actually have the NASDAQ lower. NVIDIA is lower. Let's jump into the heat map and see what the dynamics are here. Right now, you can see NVIDIA down 3.5%. Some of the other big tech names are Broadcom down 5%, Google down more than 2%. But the financials are showing some strength today. They started off the week on a weak note, so a bit of a mixed picture here. I want to jump into Salesforce. Those shares are actually higher after being lower in the pre-market. That's why we keep an eye on these things. They can change. A beat on sales and profit. The forecast disappointed. The street's putting it all together, and right now it is sending the name modestly higher. Let's jump back to NVIDIA. It was a strong quarter, a strong forecast. Is it enough? It doesn't appear to be at the moment for the street, and that is what we're going to dig into in this show. Joining me now in studio is my colleague Hiran Amin from our direct investing educational team, and Art Hogan, Chief Market Strategist with B. Riley Wealth. Gentlemen, thanks for being with us today. Before we dive into the conversation, just want to remind our viewers that the views and forecasts expressed are solely those of Art and his team at B. Riley Wealth based on their research. Art, we got the NVIDIA results. The market really hypes going into NVIDIA. It's make or break it for the market. And the quarter was strong. The forecast is strong. The shares are down. What is your big takeaway from what you got out of NVIDIA?
Yeah, I'll tell you this. I think Jensen did a great job on a conference call talking about NVIDIA and its prospects going forward, because we all know the rapid growth NVIDIA has seen over the last 3 years and arguably over the last 10 years. But it's all about the future and giving us appropriate guidance that always ends up being a bit conservative from what where they end up landing. The problem with NVIDIA right now is interesting. It's threefold, and one is that we expect this beat, and it's amazing that you expect a beat by $5 billion on revenues every single quarter, and yet they do that, and yet the stock seems to have been stuck in the same place for if you look at the chart going back about 6 months, it really hasn't deviated from where it is. The good news is it hasn't collapsed like some of the software names. Bad news is we haven't seen much gain. So while that's happening, we've got a stock that's throwing off a multiple of about 23.7 times. So to give you some reference there, McDonald's is trading at 25.5 times. Coke is trading at 26 times. So you've got the largest company in the world that's publicly traded, trading at a multiple that's below some of the consumer staple darlings that have certainly seen a bid this year. But I think in general, the good news is the tone of NVIDIA being at the tip of the sword for all of the build out of artificial intelligence as all the hyperscalers work endlessly towards that large language model dream. The prospects are good. So I think as a barometer for artificial intelligence, we got more good news than bad last night.
So we got more good news than bad as the barometer of artificial intelligence, yet the markets don't seem all that excited. People think of it as lifting the broader space. What do you think some of the concerns out there are in the market right now? If NVIDIA can post numbers like this and guidance like this and the market moves lower, what's going on?
Well, a couple things. First of all, we're going through a threefold concern about artificial intelligence. First and foremost, and this started at the end of last year and into this year, it's that CapEx spend and the duration of time we need to go through before we see a return on the invested capital. So there's a concern about some of the massive capex that's going on, and when will that turn into profits? So that's where we're starting to see some dispersion amongst the artificial intelligence darlings, right? So we don't know what OpenAI is doing, but we certainly know what their last funding round was on a valuation basis. But the winners and losers in that stack seem to have migrated. So now we have Alphabet or Google with the Gemini project, who sits at the top of the stack in terms of the best of the chatbots, getting the closest to reasoning. Next to that is Meta, where they've actually shown a path for return on invested capital in the form of advertising. So those are the two beauties here. And then you flash forward a couple of weeks, and you've got everything in artificial intelligence is going to destroy everything else in the world, which is probably a concern that's very overblown. So technology investing in general has been sort of had this sort of dark cloud over it, because we're concerned on a week-by-week basis there seems to be another sector that is going to be destroyed because of artificial intelligence. Luckily, I think Anthropic came out and said that's likely not the case. We're likely going to see something more like partnering with AI agents and making software more productive and not replacing it. But right now we're in that sort of, we don't want to buy anything in technology mode, whether it's in software or in hardware, except for memory. And memory has been taking all of the sort of investment attention away from GPUs and put it on CPUs, and that's because of the realization that we got at the end of last year and into this year that you just need a lot of compute power just to run data centers, not to actually train models, but just the massive build out in data center is going to need a whole lot more memory. So that's why we've seen the traditional memory names, the DRAM darlings like Micron, all of the semi-cap equipment companies sort of take the lead in semiconductors. That's probably a positive transition, but it's at the cost of some of the GPU darlings like AMD and NVIDIA right now.
Art, it's a tale of two AIs is what I'm just hearing. So, we just heard the chip side of the AI story. We've seen a lot of whack-a-mole, as you mentioned, in the software sector and adjacent sectors as part of it. I think Goldman Sachs CEO David Solomon just put it as being on a garage sale, stating the sell-off is too broad. So which camp are you in? I know you said it's also overblown. Does this AI disruption have real teeth to it, or is it just an overreaction?
No, I think it's a narrative that gets easily baked into the market, especially at the edges of the market where speculation runs rampant, right? So you come out 3 weeks ago, there was an artificial intelligence-driven tax product that was going to make Charles Schwab go away, right? So, to the extent that even makes sense, you saw all the financial services companies get hit. 2 days later, there was an artificial intelligence logistics application that took all the trucking stocks down. So just think about that for a second and take a step back and try to rationalize the reality of what artificial intelligence is likely going to do. And it's likely to make all industries, every company in the S&P 500, more productive, but likely not going to destroy as many industries as have been sort of caught up in this whack-a-mole trading that we've seen over the course of the last several weeks.
Okay. So does this actually change how comfortable you are then with your overall tech exposure that you have right now?
Yeah, we've been market weight in most of the technology sectors, which has been the right place to do. It certainly hasn't helped us. On the other side of that barbell, we've looked at things like industrials and materials and financials to balance that weighting out. But no, I think technology is on if not a garage sale, certainly a fire sale across the board. When you look at companies like Microsoft trading at a 22 multiple, not likely going to be displaced by artificial intelligence. At the enterprise level, it's likely going to become that much more important, I think, across the board. The good news is, if you look at the IGV, which is the semiconductor ETF, that's finally found a bottom here and has been bouncing for the last 3 trading days. I think that makes sense. The problem with the IGV is it's got all the software names in it. You can short the ETF, so it actually draws down the entire complex instead of having any dispersion or any differentiation between those companies. Most likely be positively impacted by artificial intelligence, but I think we're starting to see a bounce here, and we've never been more comfortable with our tech exposure.
Okay, let's talk about also like the yields. We've seen yields pretty elevated right now. They're offering real, competition in the equity space, and specifically when we think about tech, can multiple expansion continue, or does tech need to now have pure earnings growth to have that next leg up higher?
Yeah, great question. I think 2 things can be true at the same time. I think we're going to see a combination right now of earnings growth, which we've seen now that we've wrapped up the fourth quarter earnings reporting season. Tech was the darling for that in terms of earnings growth in a earnings season where the S&P 500 threw off 13% earnings growth and is guiding towards 14% earnings growth for this year. So earnings growth in and of itself in the tech space is going to be one piece of the puzzle. But when we looked at how depressed multiples are on a historic basis for all of technology, we can see both those things happening at the same time. You don't need it to all be multiple expansion, which is what we saw in 24 and 25. You've got very strong and steady earnings growth that'll help drive that product. But I certainly think some mean reversion back to a historic norm in terms of multiples would certainly help lift the space.
All right, when I think about some of the market moves this year, if someone was just an index investor and all they were doing was looking at the top line of the S&P 500, they'd say, I don't think there's much going on, but there's so much going on under the surface. This big move into defensive sectors. I think a lot of people are trying to figure out, does this mean something? Are we getting defensive for a reason, or is it just money finding different pockets of opportunity in the market?
Yeah, Greg, that's such a great question. We saw that at the beginning of the fourth quarter of last year, where you started to see this outperformance of everything that wasn't technology. And that's probably a healthy place to be. We spent 2 full years where there was only 2 sectors out of the 11 S&P 500 that outperformed the index. And that was tech and communication services, which the Mag 7 live in. So to the extent that we're finally seeing that broadening out that investors have been looking for, it certainly has kept at the index level things relatively placid, right? So you've got an S&P 500 at or near an all-time high. You've got an equal weight S&P 500 up 7% on a year-to-date basis. You've got a Russell 2000 small cap up, call it 6.5%, 7% on a year-to-date basis. I think that's a real positive that we're seeing it broadening out. Where that gets dangerous is if, in fact, that sponsorship of the underperforming sectors gets overbought. And I think that's where we start to get a little concerned. Look at the staples. Historically, if you went back 25 years, the staples in and of themselves traded about 15 times, and they're all trading north of 20 times, with some of them trading north of 25 times. So that sort of rotation can get overdone, and I think when we start to see some of that come out, you'll see it rotate back into some of the things that haven't worked. I think like financials and healthcare for sure, but I think a broader market with an S&P at or near an all-time high is a much healthier place to be than we were talking about in 24 and 25, where it was just about 7 stocks and the other 493 were really not pulling any weight.
Art, talking about the S&P 500 being in a healthy place, the Q4 earnings scorecard thus far shows about 9%, growth year over year on revenue, about 12% on the EPS side of things. So does this earnings season reinforce economic resilience, especially if we just had the first GDP print come out that was fairly weak? Or are we seeing early signs of possible profit deceleration happening?
No, I don't think that's the case. As a matter of fact, if you look at the guidance, there was 58% of companies actually took their guidance up for the full year of 2026. I think that's a positive. I think looking at GDP on a single quarter basis probably is a bad way to sort of measure that, and understanding the way that's measured with the balance of imports and exports, which really throws a monkey wrench into the thing. I think you want to annualize the GDP growth rates. So let's say we're going to grow north of mean. So our mean growth would be about 1.8% GDP. Last year, we're, call it 2.3, 2.4% GDP growth. This year, we're slated to be somewhere between 2.5 and 3%. That's enough to drive earnings growth, I think, which is now consensus at about 14% for the S&P 500 for the calendar year of 26. So I think that sort of earnings deceleration story is less concerning. I think what's more important is the market has certainly broadened out and started to give sponsorship to things that were just being ignored for 2 full years when this AI revolution really started.
All right, I want to get into, it's not even been a week since the Supreme Court struck down a key part of Washington's trade policy. We got tariff uncertainty again, but as we said, we got major indices near or at all-time highs. Is the market not pricing in the risk of trade? Because it sure got very nervous a year ago in April.
Yeah, well, 2 things on that. Yes, the Supreme Court struck that down. Unfortunately, Plan B immediately replaced the original plan with exactly the same thing. So the average tariff on an imported good on balance was at or about 14%. There's different industries that had some carve-outs, but it was basically a 14% tariff. That's been replaced with a 15% tariff. The problem, though, on the uncertainty front is the 122 rule also being applied legally. And this is something that was brought forward to us by the removal of the U.S. dollar from the gold standard back in the early 70s, and this was put out in 74. It's never been used, and it's supposed to be used if there's a disequilibrium in global payments, which there isn't. So unfortunately, Plan B looks very much like Plan A in terms of its application probably not being legal. So that just causes more uncertainty. And all along the way, there are other things that the administration can use to apply tariffs, but that takes time, and you have to get more approval for that. You have to go through investigations. So this whole tariff uncertainty hasn't gotten any better. And while there's uncertainty around tariffs and trade, companies don't make big decisions, right? Whether it's decisions about what their input costs are going to look like, whether or not they should move manufacturing into a different location, whether they should, have a much more diverse supply chain, and whether they should hire people. I think one of the biggest pieces of the puzzle in our slow to hire, slow to fire labor market right now is companies working through a lot of uncertainty and causing indecision. So I think that's, the good news is the Supreme Court struck that down, and the rule of law exists. The bad news is Plan B looks a whole lot like Plan A, and will probably cause as much uncertainty as we had before.
All right, let's stay on the uncertainty theme, Art, and nerves as well. And if I may borrow a phrasing from Jamie Dimon describing private credit, when you see one cockroach, there are others. And we perhaps got the other cockroach when Blue Owl rattled confidence in the corner of shadow finance marketing that has been really treated as untouchable. When the headlines came out, I think it was just at the end of last week, where they're effectively barring the exit doors. So in other words, they put redemption limits on one of their funds. So do you think this is contained, or is this the canary in the coal mine?
Yeah, it's really tricky to say. So first and foremost, taking a step back and looking at this holistically, private equity has long been an investor in private software companies, hoping to have an exit strategy at some point in time in the public markets. But since the software sector is under fire here, a good 30 or 35% of what private equity holds, and therefore also private credit is backing, is in the software space that is not going to see an easy exit in the public markets this year, or at least in the current environment. So that's one of the things. On a valuation basis, it's hard to know where the marks are for some of those investments. But remember, that's 30, 35% of what private equity and private credit likely are backing. That's not the entirety of the pie, but enough to cause a concern. And I think the valuations for some of the publicly traded private equity and private credit companies has started to reflect that pretty clearly. So at the end of the day, what does all of that mean? I think what Blue Owl is actually doing is saying, this fund is running out of gas. We're not getting an exit strategy. We're going to unwind it. And that means we're putting up gates, sell what we have, sell what we can, and then give back money at the basis of when we start selling these things off. So as opposed to putting up gates, they're really putting up gates to close this. They want to close this fund and move on to other things. And I think that's where we stand in private credit. So is it the kind of apocalypse that sometimes we make it out to be? Probably not, but it's certainly the logic behind it makes sense, because if you're 30% long private software companies that you thought would see an exit last year or this, that environment has changed quite a bit in terms of valuations, and you're likely going to have to move on to other things.
So, Art, we got concerns about private credit. We got concerns about trade and tariffs. We're wondering about this AI trade and whether, the big hyperscalers are spending too much money. We haven't even talked about Iran and the U.S. and what could happen in the next couple of days. We're unsure about that situation. So my question becomes, if you have fresh capital today, what do you do with it? Do you add to risk? Do you wait for some clarity?
Yeah, well, unfortunately, Greg, as you and I know, because we've talked a bit over the last 10 years or so, is waiting for clarity never happens, right? So to the extent that let's wait till NVIDIA reports, and if we do that every year, we're going to be disappointed. Let's wait until there's no geopolitical uncertainty, because that never happens either. So we obviously, one of the hotspots right now is with the U.S. and Iran. Hard to know how that plays out. But if you go back through the history of equity markets and the history of wars have never been the cause for a drawdown. The cause for drawdowns have been economic disasters, monetary policy mistakes, things of that nature. But there's an old adage about wars, and they don't cause bear markets. It's mistakes made by central banks and policy that's out of whack with reality. So to the extent that if you're going to wait for the skies to clear and all of the uncertainty to dissipate, you're never going to invest. So to us, we think if you're a long-term investor and you have a diversified portfolio, sort of tuning out some of the hyper scary news that's out there is probably the best thing to do, because over the long run, equities are going to do better. 72% of the time, markets are up, and agnostic to all the things that are scary to us right now. You're going to tend to do better. So just think about the fact that we've got a Russia invasion of Ukraine. that's now almost 4 years old, right? You know, imagine being out of the market for the last 4 years because you were concerned about the adverse effects of what that might be. You know, oil's going to go to 200 or not, and all of those things that came along with that. The same thing will be true around Iran. You know, we'll see what happens there. It will come and go, but I don't think it changes what you're doing in a long-term investment plan.
Art, if I were to just sum it up today and ask you to identify the single most important catalyst, and I'll be generous and say maybe a couple, whether it's positive or negative, that will define where the markets go in the next 90 days, what would you pin it on? Is it Fed clarity, earnings-driven bottom in software? Is it a tariff resolution, private credit woes, or is it something else entirely?
Wow, I like that whole package. I like to buy that whole basket right now. And any one of those things or any couple of those things, certainly an earnings-driven clarity around software and not being at the beginning of a total wipeout. And I think if you look at valuations in software, I think we're starting to get to that level. Extremely oversold, technically oversold on a multiple basis. I think the realization of that, if that starts to percolate in, and more companies coming out and saying, here's who we're partnering with artificial intelligence, and here's how much better that's going to make us for you, the enterprise. I think the second thing is clarity around from the Supreme Court around the Fed. You know, is Lisa Cook actually going to still be a governor? What are we doing with Jay Powell? Will the new Fed chair be actually approved by Congress? And all those things are intertwined. So actually, if by June we actually know who the chair of the Fed is and who the governors are, I think that'd add a whole lot of clarity around the path and direction of monetary policy, and I certainly think that would help. And that would bring us right into the midterm elections, and that always adds a little volatility to the mix. You know, any midterm election year tends to have some volatility, and if you start looking at polling numbers, I think getting to the other side of that will certainly help us, and all of that can happen easily in the next 90 days.
Art, always great getting your insights, and thank you for your time. Hope we can do it again real soon.
Sounds like a plan. Thank you, guys.
That was Art Hogan, our Chief Market Strategist with B. Riley Wealth. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. What I'm loving about this show and the format of this show is I get to talk to all these people here and that I used to talk to at being at Bloomberg for years, because they've got great insights, and Art always has great insights. So much there. I'm going to go back to the rotation we've seen in the markets and how the markets are getting defensive, asking so sometimes that makes an investor nervous, right? Art's saying basically like it's a healthy place to be, but it can be a dangerous thing if these sectors start to get overbought and it gets to be overdone. That really sort of jumped out to me, is because I think when you see this move and this market rotation, people start to worry, is the market getting ahead of some other event that I should be worried about? And right now he's saying, well, you know, if the money's moving out of tech, we were concerned about it was too concentrated there and spreading out to the market, why shouldn't that be a good thing?
Yeah, and just to follow up with that, I think one of the things that I took heart from was the fact that, you know, the whole software space being disrupted, and, you know, kind of Anthropic walking back and saying, we're not here to disrupt this space, we're here to really partner. And maybe it was a strategy in my mind, you know, hey, let's show this case and get some other people to join us in kind of the productivity tools. So I think that's important to note, especially, you know, he mentioned that he believes that it's a little bit oversold, you know, with what the market's reacted the way it has so far. And then there's been some walk back in it. But just coming into, you know, and he made some important remarks heading into the midterms now, what are some of the things that what are the pieces that need to fall in place for us to have this volatility smooth out and possibly have investors have more confidence to see if there's another leg up, especially if the earnings are corroborating that story.
It's a great chat, definitely one worth going back and listening to again. But wait till we're finished the show, because we got more show for you. If you at home have a question for our guest or our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free by opening a practice account. Click on Try TD Active Trader, that button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. We got Hiren with us here in studio. Of course, we're going to do a technical take today. We're talking Marvell Technology, set to report earnings next week. What do you got for us here?
Yeah, let's talk about it, Greg. You know, semiconductor stocks have been clearly the AI winner throughout this bull market. Their outperformance has been made ever more stark actually in 2026 when you take out the sum of the numbers. Marvell Technology is one of the companies we want to look at. They design and sell specialized semiconductor chips, so custom silicon primarily to data centers, cloud providers. They do have a presence in the telecom space as well. But the real value that Marvell brings is that they have positioning across all the critical infrastructure pieces within AI. So they go from optical interconnects, the switching to accelerators, and this is happening during a multi-year build cycle. So they have their earnings coming out next week on March the 5th. They're expecting to report about $2.2 billion. Well, happy early birthday to him. $2.2 billion in revenue, 79 cents EPS on that side. So really healthy year-over-year growth there and setting the bar for a potential beat. But the big thing for investors that will be watching on the key trends is AI data center silicon customs orders, the connectivity and custom solutions. And now since this is their biggest segment in terms of revenue and growth, that could be the difference between a good and a great print that they're going to have. The other thing that investors want to hear is they did a number of acquisitions, a couple of acquisitions. Most recently was Celestial AI's photonic fabric acquisition. Thankfully, I said that correctly. That's going to be the key catalyst. And the reason why that's a catalyst because it adds about $10 billion to their TAM and offers margin additive growth. But there's also a reason it solves a big problem in the infrastructure space right now, and that's what's known as memory bottleneck. Basically, Greg, it's copper wires. They have limits to how much they can transmit the data. With this acquisition, they're basically using photon fabric, which is basically light-based communication, which solves the issue and provides about a 10x increase in bandwidth density. And that means all these GPU clusters can have a free, like a free highway, basically like the Autobahn of Germany.
Think even faster.
They can go as fast as they
even
can.
faster.
Exactly. So that'll be key. What we'll want to look at, the one risk they do stand is based on their full year 25, they did have 40% exposure to China. And that means that could be a substantial risk if there's any ongoing geopolitical tensions and pullbacks in terms of the tariff war. When we look at the charts, it's actually fared not too bad. I mean, we've still seen it maintain sort of this bullish run. We've seen a little bit of, I would say, a minor correction happen, just a little bit of chop. You can see, I'm going to point out two important patterns on the chart here first. The bigger pattern is the symmetrical triangle. This is formed on the longer term sort of pattern, just going over about a year now. And what this pattern really signifies to us is either going to show us a breakout to the upside or the downside. It really depends on which side the pattern is going to break out. So right now the levels are sort of converging. We want to see if we are going to see a bullish run. We need to see it first of all tackle off the resistance at 85 and then push up beyond this where we could see another push up higher. On the downside, there is still risk because it's really just sitting on its bottom there on the lower, which is acting as a sort of a support area. The other pattern I'm going to show you is the shorter term falling wedge that's formed. Again, this is a bullish reversal pattern. We've seen the breakout. Today it's kind of poked its head back in after poking it out. Again, we want to see it clear it and move above the moving averages that we've got. You can see the 21 days right now below both the 50 and the 150-day moving average that I have here in blue and orange respectively. So we want to see price move above that, clear there. We want to see confirmation, at least 2 closes above that. So next week could be the catalyst to really push us to the prices. Earnings expectations about a 10% move. So that could mean right now, based on where the stock's trading, just shy of the $80, that could push us beyond this 85 and broach the 95, which has been a key resistance. You can see multiple rejections over here. On the downside, we could push down below and test the 72 if it does come to it.
All right, Hiran has done the chart work now. He's going to walk us through a couple ways we could trade Marvell. But before you get going on that, just a reminder to our viewers that options trading carries high risk. It may not suit all investors. Significant losses are possible. So it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Take it away. I know you like to start with the bull all the time.
Yeah, let's go with the bull.
You're such an optimistic guy.
Now you said that, let's go to the bear trade. That's what we're going to do. Let's start with the bear trade. You know, if you have the belief that, you know, the way that the stocks have behaved so far, even despite good earnings, they could see a little bit of a, you know, pullback given the valuations, then here's one trade you could look at. So the bear trade that we've got as an example is going to be a front ratio put spread. Explain what this is. So right now, when I was looking at kind of the options profile and the volatility, it's sitting at about 45, which is kind of that midpoint when you look at the overall range. Expected move is roughly just under shy of $10. So what this strategy essentially is, we are looking for downside moves. So we're looking to buy a put. I'm squarely going pretty much at the money right now, which is the 80 strike put. We're going about a month out to give ourselves a bit more time. And then we're looking to sell 2 contracts further below at the 74, where we believe there could be a base forming there, maybe that key support area. And this is where that ratio aspect comes into the strategy. We're selling 2 versus just buying the 1. So there is a bit of uncapped risk, I would say, because we have technically a naked single put option there. So what this trade does, and one of the beauties is that you eliminate upside risk, and I'll tell you why. So usually when you do a symmetrical trade where you're not doing the ratio, you would be paying a debit. You'd be paying money. But in this case, we actually collected a credit. We collected $1. It's not a big amount, but it's still $1. That means even if the stock doesn't move down and stays above 80, we actually don't lose money because we collected $1 on there, so we get to keep the dollar. The best case scenario though, Greg, of course, and I'm gonna cue it up here. Let's look at it. So the best case scenario is if it falls and we need it to pin right at $74. That's when we make the best case scenario. That means we'll make the distance of the spread, so that's $6 plus the dollar that we collected. So in overall, we'll make $7 or $700 in a single contract. But then the loss is where it gets a little bit hairy because we've got that naked put option. So the worst, theoretically, the stock could just go to zero. And that means if that happens, we would be out our break-even price, which is $67 or $6,700. But also, because we have a naked put option and goes in the money, it means we have assignment risk. We'd have to take delivery of that stock, and that'll be put to us. So that's another thing to consider when you're putting this trade. It does give you that uncovered exposure, so just be mindful when you are trading something like this.
Okay, there's the bear side. What about the bull side? What if Marvell bucks the trend?
All right, so let's do the bull side now. This one is, again, we're looking to collect some premium on this trade. So one of the ways you could consider doing is what's a short strangle trade? You'll get the theme of today's trades are very risky. This one is kind of risky, and I'll explain why. So what a short strangle essentially is, we're trying to map out where we think the stock will move and just going outside of that in terms of selling our two options that we have. So this is what a strangle is. We're looking to sell a call option. In this case, we're going for the 95 because we believe clearly, based on the past price action, there's been a strong wall of rejection over there. A lot of sellers are hitting at that level. So that's where we're looking to sell a call, going out to the April cycle here. And on the downside, we find the 70 is a base where we're seeing buyers shoring up their stock. So this is kind of the range we want to play in. It is looking to collect an overall credit on this trade. So we are looking to collect roughly, looks like we're getting about $6 credit. Overall. So what this actually means, and I want to show the audience, is we've got our break-evens. We've got two break-evens in this trade because you could have the move to the upside and the downside. So the stock either has to go to 101 for us to start losing, or it has to drop to 64 for us to stop losing over the next 2 months. So it gives us a good probability of odds based on those ranges. So in terms of ideally, what we would like to happen, max profit, is we just want it to stay between 70 and 95. That means we make max profit. You can see this is our max profit zone. We'll get to keep the $6 or $600 on a single contract. If it does move meaningfully, then we will stand to lose. Essentially, there's two sort of loss scenarios that can happen. On the call side, whenever you sell a naked call, there's unlimited risk on the upside because in theory, the stock doesn't have a cap on how high it can go. So that's why we say it's unlimited. Or on the downside, the stock could go to zero and we would be out 6,400 in that case if we lose it on there. Again, a very risky trade because we're completely uncovered. You could do like an, you could do what's called an iron condor by just buying either side to cap your risk. But if you have more conviction, then this is one you can collect a bit more premium.
All right, interesting ideas there. That's almost our show for the week. I want to round back around to the S&P 500 because if you had a proper updating quote, which I didn't have on my terminal this morning, you would have said, why is Greg saying that the S&P 500 is up when it is clearly down? Why isn't he trusting his eyes? Because my eyes were looking at a different number that is frozen. I got some frozen quotes on my screen that still haven't ironed themselves out. So when I sat down, I was like, what is going on? The market is lower. Not a surprise with NVIDIA pulling back on its earnings as well, and other tech names. I thought, wow, is there some pocket of strength somewhere else in the market that's making this move? And it's like, maybe go for the most simple explanation. The line is down, the market is down. Now that is our show for this week. As always, investors should perform their own due diligence before engaging in trading. We will be back on Tuesday, and we decided just the other day what the debate topic's going to be.
It's going to be Oracle.
Yeah,
good thing I remembered on that one. Yeah, we're going to go head-to-head with Jay. I'm going to go head-to-head with him on that one. We still have to do a proverbial virtual coin toss, so we'll see what happens.
Don't leave it to me, because the last time I did I complicated it.
That didn't end up well.
In the end, I tossed and I wasn't even sure what the result should be. It's like, wait, what does that mean? So I'm going to leave it to you guys this time.
Yeah, well, we'll get it figured out. We'll let you know on Tuesday what happens.
Yeah, sounds good. Thanks for watching the show. We'll see you on Tuesday.